studying your last two. I swim with tea when they turned in. The staring down to mute and can learn the pole that sunk he died.
In this slide, we'll introduce Schedule 21, which is used to claim federal foreign income tax credits. The purpose of Schedule 21 is simple, but extremely important. It helps prevent double taxation on foreign income. Let's understand why this is necessary. Imagine that a Canadian corporation earns income from another country. This could be foreign bank interest, rental income from property located outside Canada, dividends from foreign companies, or income from carrying on business in another country. Because that income is earned outside Canada, the foreign country may tax it first. However, since the corporation is also a Canadian tax resident, Canada generally taxes the corporation on its worldwide income, including that same foreign income. Without any relief, the corporation could end up paying tax twice, once to the foreign government and again to the Canadian government. This is what we call double taxation. Schedule 21 is designed to solve this problem. The flowchart in the center shows how the process works. First, the corporation earns foreign income. The foreign country withholds or collects tax on that income. The corporation then reports both the foreign income and the foreign taxes paid. Using Schedule 21, it calculates a federal foreign income tax credit. That credit is then used to reduce the Canadian federal tax that would otherwise be payable on the same income. Notice that the foreign tax itself is not refunded by Canada. Instead, Canada recognizes that tax has already been paid to another country and allows a credit against Canadian federal tax, subject to the rules and limitations of the Income Tax Act. The panel on the left highlights common types of foreign income that may qualify for this treatment. These include foreign bank interest, foreign rental income, foreign dividends, and income earned from business operations outside Canada. The panel on the right illustrates the problem that Schedule 21 is intended to prevent. If both the foreign country and Canada tax the same income without any relief, the corporation would suffer double taxation. Schedule 21 helps avoid that outcome by providing a foreign tax credit. The shield at the bottom represents that protection. Think of the foreign tax credit as a shield that stands between the corporation and double taxation. It reduces Canadian federal tax to recognize foreign taxes that have already been paid. The key takeaway is this: Schedule 21 helps prevent paying tax twice on the same foreign income. It is an important part of Canada's international tax system, ensuring that corporations receive appropriate relief when their foreign income has already been taxed outside Canada. Now that we understand why Schedule 21 exists, let's see how the foreign tax credit is actually calculated. The process begins when a Canadian corporation earns income from a foreign country. This could be interest from a foreign bank account, dividends from foreign companies, rental income from property located outside Canada, or other foreign source income. In our example, the corporation earns $10,000 of foreign income. Before that income reaches Canada, the foreign country withholds or collects tax. Suppose the foreign government has already collected $1,500 of tax on that income. At this point, without any relief, the corporation could still be required to pay Canadian tax on the same $10,000, creating the possibility of double taxation. This is where Schedule 21 becomes important. Using the information about the foreign income and the foreign taxes already paid, Schedule 21 calculates the federal foreign income tax credit. That credit is then used to reduce the Canadian federal tax that would otherwise be payable on the same foreign income. To complete Schedule 21 correctly, the corporation must gather several important pieces of information. It needs to know the amount of foreign income earned, the amount of foreign tax paid or withheld, the country where the income originated, and supporting documents such as tax statements, withholding tax certificates, or other evidence showing that the foreign tax was actually paid. There is also an important limitation to remember. The foreign tax credit cannot exceed the amount of Canadian federal tax that would otherwise be payable on that same foreign income. In other words, Canada will not provide a credit that is larger than its own tax on that income. For example, suppose the foreign country withheld $1,500 of tax, but the Canadian federal tax on that same income would only be $1,200. In that situation, the maximum federal foreign tax credit would generally be limited to $1,200. The excess foreign tax cannot simply be refunded by Canada through Schedule 21. The simple formula at the bottom summarizes the result. Start with the Canadian federal tax that would otherwise be payable. Subtract the allowable foreign tax credit calculated on Schedule 21. The result is the corporation's net Canadian federal tax after taking credit for foreign taxes already paid. The key takeaway is this: the foreign tax credit reduces Canadian tax. It does not refund foreign tax. Schedule 21 recognizes taxes already paid to another country and helps ensure that the same foreign income is not taxed twice, while still respecting the limits set by Canadian tax law. Now that we understand why Schedule 21 exists, let's see how it actually calculates the foreign tax credit. The process begins when a Canadian corporation earns income from another country. For example, suppose the corporation earns $10,000 of foreign interest income from investments outside Canada. Before that income reaches the corporation, the foreign country may withhold tax. In our example, let's assume the foreign government withholds $1,500 of foreign tax. Without any relief, the corporation would still have to include the full $10,000 of foreign income in its Canadian taxable income. That could result in Canada taxing income that has already been taxed by another country. This is where Schedule 21 becomes important. The corporation reports both the foreign income earned and the foreign tax paid. Schedule 21 then calculates the amount of federal foreign tax credit that the corporation may claim to reduce its Canadian federal tax. In our example, the corporation reports $10,000 of foreign income and $1,500 of foreign tax paid, subject to the applicable rules and limitations. Schedule May 21st allow a foreign tax credit of up to $1,500. However, there is an important limitation. The foreign tax credit cannot exceed the amount of Canadian federal tax that would otherwise be payable on that same foreign income. This prevents the credit from creating a negative tax balance or generating a refund beyond the Canadian tax attributable to that income. The panel on the left shows the information needed to complete Schedule 21. The corporation must know the amount of foreign income earned, the foreign tax paid, the country where the income was earned, and maintain supporting documents such as tax slips, withholding tax statements, or foreign tax certificates. The calculation at the bottom demonstrates the result. Suppose the Canadian federal tax that would otherwise be payable on the foreign income is $3,000. If the allowable foreign tax credit is $1,500, the Canadian federal tax is reduced to $1,500. Notice what the credit does. It reduces Canadian tax. It does not refund the foreign tax that was already paid to the foreign government. The key takeaway is this: Schedule 21 gives credit for eligible foreign taxes that have already been paid, reducing the Canadian federal tax on the same foreign income. It is a tax credit designed to prevent double taxation, not a mechanism for recovering foreign taxes from another country.